For more than half a century, Luxembourg has been a centre of excellence for international and cross-border financial services. Having flourished alongside European integration and the common European market, Luxembourg today acts as an EU hub and competence centre to the world's leading financial institutions. Catering to the needs of global investors, the financial centre provides a unique combination of international expertise, a complete toolbox of investment products, and highly specialised financial institutions and service providers. From wealth management, treasury and corporate banking to fund services, banks in Luxembourg have specialised in serving clients across borders. In Europe's leading fund centre, asset managers find the perfect ecosystem to launch and distribute funds to investors across the world. Luxembourg's insurance industry has decades of experience in developing solutions to meet the needs of highly mobile citizens and multinational companies. Centre for international debt listings, securitisation and post-trade services, Luxembourg is the right place for companies to finance their global activities. English-speaking regulators and administrations, access to a multilingual and highly skilled workforce, a AAA-rated stable economy, an innovation-friendly digital nation, an international business environment right in the heart of the European continent. Luxembourg provides the ideal environment for international banks, asset managers and insurance companies to thrive within the European Union and beyond. Grow beyond borders. Luxembourg.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
A warm welcome, ladies and gentlemen, to all of you who have joined us for this new episode in our Focus On series. Today we focus on Brexit, a topic that has been with us for the last 4.5 years, ever since this fateful referendum. In the coming days, we should find out whether the negotiations between the European Union and the UK can produce an agreement as a basis for our future relationship. The encouraging sign is that even the bookmakers have the deal scenario at 60 versus 40% for the no deal scenario. To make such a deal possible, however, compromises will still be needed from both sides. Obviously, this could very well end in good old EU fashion with cod quotas being traded against MiFID equivalences. In order to understand what this future relationship will mean for the financial industry, we have assembled a program that brings to you representatives of government and industry, both obviously at the very highest level. But before we can get there, I need to make one point, and that is about diversity. You will obviously realize when you listen to our discussions today that our cast is today all male. Luxembourg for Finance is and remains obviously very much committed and yields to no one in its commitment to diversity. Sometimes it just so happens that a cast is all male, and at other times, such as for instance our Sustainable Finance Forum in 2 weeks, we have an all-female panel. What is important is that we will continue obviously to strive for diversity across all of our event calendar. This being clarified, ladies and gentlemen, let me turn to His Majesty's Ambassador John Marschall. I'm very honored to have you with us today. Ambassador Marschall, you have been very gracefully representing the United Kingdom in Luxembourg from even before the referendum. And you certainly are very well placed today to give us the view from London. Ambassador, the floor is yours.
Thank you, Nicolas. And first of all, I'd like to thank you and Luxembourg for Finance for the invitation to contribute the view from the UK in your discussions today on the future relationship between the UK and the European Union. I've become accustomed over the past few years to speaking on Brexit and now our future relationship at very fluid moments in the process, with one eye on my smartphone for the latest developments. And this week is another crunch week. I don't get daily blow-by-blow accounts on every last detail of the negotiations, and it's absolutely right that I don't. So what I'm about to say may not reflect every nuance of the latest situation, but my key messages will be clear. As you know, following the government's decisive election victory in December last year and the subsequent swift ratification by the UK Parliament of the renegotiated withdrawal agreement, the UK left the European Union on the 31st of January this year, and the transition period provided for in the withdrawal agreement will end on the 31st of December. From the 1st of January, the UK will recover its political and economic independence, and once again, we will be able to control our own laws and our own trade. What is unclear, as of today still, is whether by the end of the transition period, the UK and the European Union will have agreed and ratified the free trade agreement and other agreements that we've been negotiating since March. Let me be clear at the outset on one thing. It has always been our preference that we should conclude a suite of agreements with the free trade agreement at its core. And we have worked hard to that end since negotiations began in March, and we will continue to do so in the last few days that remain. Because by the end of this week, we need to have a clear sense of whether a deal is actually possible and what it is. If by the end of this week we haven't made sufficient progress on the big, difficult issues, then we will have to conclude that a deal is not going to be reached and switch our resources and attention to preparing for the alternative. Of course, if we fail to reach agreement, there will be those who who will say that we should have given ourselves more time by extending the transition period. But as I said to the Benelux Parliament last week, anyone who thinks that is mistaken. The difficult issues we've faced won't get easier with more time. Extending the transition period would simply have dragged out the negotiations and prolonged the uncertainty, which isn't in our interests or the interests of the European Union. As you know, the most difficult issues that we faced have been on subsidies and fish. And the reason they've been so difficult and that progress has been slow is that in these areas, the Commission have taken an unprecedented and frankly unreasonable approach. On fish in particular, we need to see more realism from the EU and urgently. We've been clear from the outset that we won't accept any proposals which compromise UK sovereignty over our fishing waters. We're seeking a relationship based on the EU's existing bilateral fisheries relationship with Norway. But for most of the last 6 months, the Commission has been camped on a position that seeks to preserve the status quo on fish. They need to recognise, just as we have done, that in this, as in all other areas, with our exit, things change. On subsidies, state aid, as the EU calls it, we've been consistently clear from the start of this process. We're seeking a relationship that respects our sovereignty and under which we will have the right to regulate. So we were never going to agree to be locked into EU rules on state aid, as the Commission for many long months was demanding. Instead, we have consistently been making proposals which provide for open and fair competition on the basis of high standards in a way which is appropriate to a modern free trade agreement between sovereign and autonomous equals. We continue to hope that in the end game, negotiations, the EU will show a more reasonable position in response to our proposals. Outside these areas, there's a high degree of convergence, as you might expect. We're not, after all, asking for a special, bespoke or unique deal. We're taking a precedented approach, looking for a deal like those the EU has previously struck with other friendly countries like Canada. In fact, had the Commission not applied a rigid approach of parallelism, we would have been able to make more progress sooner in many areas. In Luxembourg, of course, we're less interested in fish, except insofar as it has the potential to scupper the talks, and more interested in financial services. In the negotiations, we have sought to provide a predictable, transparent, and business-friendly environment for firms to undertake cross-border financial services business. It's disappointing that the EU has not sought to engage with our proposal for regulatory cooperation within the framework of the Free Trade Agreement, but it will make sense to return to the issue of cooperation in due course. And as we have always said, cooperation mechanisms should be proportionate to the level of market access agreed. As you know, the process of equivalence assessments is taking place in parallel to discussions of the future UK-EU trade relationship. At the moment, our rules are the same. In future, some will change. No matter what the sector, we are committed to regulatory autonomy. And that is why we made clear from the outset that we would not agree to rule-taking by the UK in financial services. But freedom to change the rules doesn't mean a bonfire of regulation or unfair competition. The UK is committed to the highest standards of regulation and appropriate levels of supervisory oversight. In many areas, we already go beyond what EU rules require. In June, the government announced a series of immediate practical reforms that the UK needs to prepare our financial sector and the UK needs to take to prepare our financial sector and regulatory framework for a future outside of the European Union. These reforms aim to update our prudential requirements, maintain the soundness of our capital markets, and manage upcoming risks. This approach is guided by our continued commitment to the highest international standards and by what is right for the UK's complex and highly developed markets and what is necessary to ensure financial stability and protect consumers. We've been clear from the beginning that politicization of equivalence is in no one's interests. The UK has been able to complete our own assessments of the EU on time. We have also returned all 17 questionnaires received from the EU as part of their assessment process, our returns totaling over 2,500 pages. To date, their decisions have been disappointing, but we remain open and committed to continuing dialogue with the EU about their intentions regarding remaining equivalence decisions for the UK. So how prepared are we for the end of this year? Ahead of a possible no deal last year, most risks to UK financial stability had been mitigated following extensive action taken by the UK authorities and by industry. These UK mitigants continue to be available for the end of the transition period. So, for example, the UK has put in place temporary regimes to enable EEA firms to continue to provide services to UK clients after the 31st of December, while they seek full authorization by the UK regulator. This includes firms providing services where no equivalence provision is available. Firms, too, have carried out extensive preparations to minimize risks of disruption relating to the loss of financial services passporting rights at the end of the transition period and to ensure they can continue to do business with the EU. And industry preparations were well advanced going into the COVID-19 crisis, meaning that the financial services sector is already well prepared for the end of the transition period. And legislation passed last year allowing UK to EU data transfers to continue in a no deal will automatically apply at the end of the transition period. MOUs between the FCA, ESMA, and EU27 authorities were agreed in February 2019, and in July, the FCA and ESMA confirmed that these would come into effect at the end of this year. This provides for the necessary supervisory arrangements that allows for the continuation of the popular business model in which funds domiciled in Luxembourg are managed from the UK after the end of this year. Of course, the UK authorities are not able, through unilateral action, to fully address risks to EEA customers of UK firms currently providing services into the EEA using the Financial Services Passport. This is a matter for EU law and member states' law and would require action from the EU or individual member states. While some mitigants have been put in place, most notably the temporary equivalence decision for the 3 UK CCPs, there is continuing uncertainty in other areas. Finally, if I may, I'd like to address a message to any British nationals resident in Luxembourg who might be watching. As you'll know, the withdrawal agreement provides citizens with the certainty they need about their rights going forward. It means over 3.5 million EU citizens in the UK and nearly 1 million UK nationals in the EU can continue to live, work, study, and access benefits and services broadly as they do now. To secure their rights under the withdrawal agreement, UK nationals living in Luxembourg must apply for a new residence card unless they have another EEA nationality or have a carte de légitimation, which mainly applies to those working for international organisations and their family members. You have until 30th of June 2021 to do so, but I encourage everyone to do so by the end of this year. There really is no good reason to delay. Thank you again to Luxembourg for Finance for inviting me today, and thank you to you all for listening.
Thank you very much, Ambassador Marschall, for laying out to us these parameters. Obviously, it is very important to us to listen to you and to get a better understanding of your views. While we remain cautiously optimistic that a deal can be struck, we are also conscious that even in that scenario, financial services, as you have reminded us, will not be covered by the agreement. They will be dealt with separately by the existing equivalence regimes. The result of the ongoing negotiations is, however, still important to financial services because their future will largely be determined by the goodwill that will exist at the end of this process between the two parties. And to make sense of what this new relationship will mean for the different sectors of the financial industry, we will now switch to our panel of experts, moderated by Charles Muller, an independent lawyer with a long and solid expertise in financial regulation.
Thank you, Nicolas, and thank you to the ambassador for this very comprehensive summary of where we stand today. As was said, financial services are not directly included in the current talks about the deal, but nevertheless, they set the mood for future relations in financial services between London and the EU27. So what is the mood going forward? What is the mood in London? What is the mood in Luxembourg? We are going to find out. But we also want to find out what your mood is, how you see things happening. So we have prepared a little poll question for you. And it goes like this. Project yourself at the end of 2021. So in roughly a year's time, where will we stand? Will relationships be smoother because we have a deal? Still tricky or tricky because we don't have a deal? Tricky despite the fact that we have a deal? And for those who are very optimists, I mean, in the European sense, we don't really care because the UK will not leave the EU in the way that is currently foreseen and will remain closer to the EU than is currently in the papers. That's the very optimistic version. So you have the question on your screen. You had the instructions for Slido to actually start voting, and I will come back a little bit later during our discussion to the results, to the way you foresee the future. The other point I would like to make as a start is that we obviously also want your opinion on anything else. So you have a little box on your screen where you can ask questions. Please go ahead, ask a question. We encourage you to also give your name, but it's not compulsory if you want to stay anonymous. And I have Chris here in the studio, who is from Luxembourg for Finance, who is looking at the questions, and he will be your voice. He will relay your questions to our distinguished panelists. So what's the mood in London? Let me start with Martin Parks, who is the Managing Director and a member of BlackRock's Global Public Policy Group. He also chairs the Investment Association's International and European Policy Committee. I've known him for a long time. He is a very old hat when it comes to EU policy in asset management. That's his specialty. Good morning to London. Martin, what's your mood today?
Good morning, Charles, and it's great to be here. So while everybody else is answering their panel, their questions, certainly projecting ourselves to the end of 2021, we would certainly expect the relationship to be smoother because once the deal has been agreed, there will be a deal of some sort, and we will move on to the daily business of UK and Europe working together. We're geographically close, and we have very many similar issues to deal with. But what we've been doing since Brexit was announced is we've had to plan as a responsible business for no deal. We've had to put the contingencies in place in terms of structuring and permissioning for our European entities, but with the hope that we would have a better outcome with a closer relationship. So the priority has actually been to make sure that our European clients can access all the products and services that they need to meet their objectives. I would highlight one point that Ambassador Marschall made, and that was the signature of the cooperation agreements between FCA, PRA, and CSSF and other European regulators, which were organized by ESMA. That close cooperation between financial services regulators is essential and was something that we saw working very well in March during the COVID crisis. And so with the conclusion of those MOUs, the structure, the really foundations for this ongoing discussion, this ongoing cooperation has been put in place. We think that's really a sort of good omen, for the future development of financial services between the two markets.
Thank you very much. So cooperation, very important going forward. Cooperation also, you pointed that out, between UK regulatory authorities and the CSSF. I think Pierre Mackel de Waersegger, the spirit is the same here in Luxembourg. Pierre Mackel, you are a partner with Arendt law firm specialized in insurance and reinsurance. You sit on board of insurance and reinsurance companies. You sit on the board also of the Luxembourg Pension Fund Association. The spirit the same, close cooperation with the UK?
Yes, of course. Thank you, Charles. Yes, the spirit is almost the same, and I must say that I'm quite glad that I do not have to answer to the poll question, because it's quite difficult to choose just one answer. On one side, as Martin just said, insurance stakeholders have prepared themselves for the worst, meaning for Brexit with no deal. And so in terms of permission, authorization, in order to continue to service their client, they have prepared themselves to be able to continue after Brexit, whether there is a deal or no deal. All the UK insurance companies have decided to establish a European hub in the continental Europe, and the European insurers have either decided to establish a branch in the UK or to opt for the temporary permission regime that we just discussed. So on this side, we may think that we are ready, and whether or not there is a deal will not have an immediate impact on the insurance industry. On the other hand, I think, like Martin mentioned, the cooperation is quite essential. The current discussion that happened during between the EU and the UK authorities are essential, because I do believe that it will set up the tone for future relationship between the UK and the European Union. And I think we must all realize that despite the political environment and political question, we need each other. If I'm looking this from a European perspective, London is an important financial center, especially in the insurance sector, where it is considered to be one of the most important insurance centers in the world. Whether there is a deal or no deal, we will still need to be able to continue to work with the London market. And therefore, what we need is to have the appropriate framework that will take this specificity into account, but also take into account the fact that we have been married for almost 50 years. United Kingdom is not any other third country. We have a very deep relationship with the United Kingdom, and we need to have this kind of framework that take into account the past relationship that we have with the United Kingdom. Another point that is quite important is, for the last 5 years, all the major stakeholders, and it is also true for the insurance sector, have been working a little bit blind. What we need now is to have clarity, is to have legal certainty of what will be the future for this insurance group when planning their business model, when planning their internal organization. What is the future that is ahead of us? Ultimately, I'm pretty convinced that at the end it is a political question, but let's face, we have already acted on the divorce between the United Kingdom and the European Union, and now it remains to be seen whether we want to be happily divorced or not.
So we have to divorce, but we want to stay married in some sort of relationship. Not so easy as a situation. Let's go back to London for my last panelist. Michael Percival is the EMEA Head of Regulatory Affairs for JP Morgan, based in London. So he is our banking man. He was with the Irish Banking Federation in Dublin before, so he also knows the Irish situation quite well, which is one of the topics that is constantly popping up in these discussions. So Michael, good morning to you in London. What's your feeling, and especially since we are nevertheless talking a little bit about this deal, there is this whole sense of freedom of movement. I know that a lot of Europeans like to work in London, and there might be a challenge there. So perhaps if you could address that situation in particular as well. Michael, what's your take on the situation?
Hi, and thank you very much. And yes, absolutely. Freedom of movement matters, and it's part of the ecosystem and the environments in which we operate as firms collectively, right? The ability to get good people into your firm and operate with high capabilities and skill sets. So that is one of the many challenges of Brexit, but certainly one that I think matters across banking, across the sector, and indeed across the entire economy. Just to come back to the point, I think there's a bit of a theme developing here, but to fully agree about the importance of the relationships between the regulators. One of the comments from His Excellency the Ambassador about the regulatory cooperation being connected to the degree of market access. Well, absolutely stronger market access and connection between markets behooves regulators to cooperate ever more closely. But also, I think we must emphasize the need, even if there were very little market access or a low market access scenario, the importance of regulatory cooperation does not dissipate, right? There are financial stability risks across jurisdictions and common issues that regulators will face on both sides, and not just indeed on both sides of the English Channel, but on both sides of the Atlantic and around the world more generally. It's about regulators speaking the same metaphorical language. It's about regulators building trust, ability to cooperate, coordinate, share information. And all of these things are extremely important, not just for the financial sector and financial stability, but also for firms and the economies that the regulators are there to essentially protect. So leading to better outcomes. So this theme of the need for regulatory cooperation, I think, needs to be really re-emphasized, despite whatever outcome the poll result tells us we're going to get.
You addressed the poll, so let's have a look at your answers to our little question. You can see, there we go. Oh, okay. So you think that there will be a deal, but the situation will remain tricky despite a deal. So that's 50% of your answers with 117 respondents. That's quite good. Some people are more pessimistic, tricky in the absence of a deal, and only 5% have chosen the other two solutions. So a deal or no deal, still 50-50 roughly, but tricky seems to be the dominant theme. Now, you have all prepared for, I suppose, the worst, even if you hoped for the best. Michael, can I come back to you and ask you, in your preparation, what are the main areas of worry that remain nowadays?
Yeah, I mean, I think some of the other speakers have already mentioned that firms have been reorganizing, restructuring as necessary in order to deal with Brexit, and obviously that will happen. I'm quite focused down the pipeline a little bit and trying to consider, where does this take us? And there's a big degree of uncertainty about where we go. One thing I would try to discern is what is the vision for financial services in the EU, and where is the end point in this journey, which ultimately it's deal or no deal in the next short period is really not. Absolutely isn't the end of the story. This is a story that will continue as we settle into a new equilibrium, and that won't happen in a binary way. That will happen over time. So it's a process, and where do we think we will be at the end of that process? There does appear to be a competing tension within Europe on these questions about, on the one hand, openness and a global perspective, and on the other hand, maybe a more inward-facing Europe, and that's very much encapsulated by a phrase that's has commonly used these days: open strategic autonomy, which in itself is a contradiction in a way. Open, obviously, referring to the global perspective; strategic autonomy, referring to a desire to enhance the onshore capabilities of Europe in the face of geopolitical uncertainties, you might say. So, on the spectrum posed by that phrase, where does the EU go, and where does the EU end up? I mean, certainly since the Brexit vote in 2016, the EU has given itself the tools to be more inward-facing, and you can see that across the whole nature of the financial sector ecosystem, whether it's from CCP equivalents being graduated to allow for a mechanism to create onshore clearing, whether it's trading venues, unlikely to be given equivalence, so another kind of form of market infrastructure, with separation between the UK and the EU, whether it's on MiFID services and the likely non-granting of equivalence to the UK for cross-border investment services, or whether it's on the delegation of portfolio management, which again is popped up again and again and seems to remain on the agenda as an open issue. Likewise, the ECB has publicly been very negative on branches coming into the EU, stating them to be an arbitrage, despite those branches coming from well-regulated, well-capitalized jurisdictions. And so all of these kind of tools are in place, and it's not just on the EU side, of course. On the UK side, there are some open questions that the UK could have cleared up the uncertainty for, but hasn't. Things like the shares trading obligation, the derivatives trading obligation, both of which, because the UK has adopted EU legislation, has you might say a mirror image obligation, which may not be able to be satisfied when there's a transaction involving people in both jurisdictions. So what are the consequences for all this, right? So big uncertainty about where we're going. And what are the consequences? I mean, obviously, as a global firm, there's an impact and a necessity to deal with all these issues as they crystallize. But the bigger question, obviously, is what is the impact on the EU economy, right? And who wins from these measures? These measures, putting up barriers at borders, it's analogous or akin to a protectionist policy, which is, something like there's a lot of economic theory. If you have a tariff at a border, you create a restriction on trade at that border. You create impacts in terms of the competitive dynamics. And the economic theory tells us, the winners from that are the firms inside that less competitive market, and the losers are the consumers inside that less competitive market. This is something I don't think the EU has really had a strong, serious debate on, is understanding who might be the winners and who might be the losers in these competing versions of where the EU goes. So I mean, this is, I guess, to the point earlier, this is uncertainty, and we don't know where we're going to land on all these issues. But obviously, they're all very, very important for the EU economy and the future of Europe generally.
I've tried to make a list of all the things that you were now putting forward: infrastructure, delegation of portfolio management, MiFID services, which is linked to marketing. And you say the EU has a tendency to be protectionist, if I understand this correctly. Martin, is that your view as well? Is your list of things that still need to be clarified the same as long as this for asset management?
I think our key concerns have really been avoiding a cliff edge at the end of the transition period, and the ability to be able to serve clients effectively and having the right business model in place to do so. There's been a lot of discussion about delegation. One thing to clarify is delegation is not dependent on a decision on equivalence. And the CSSF's own guidelines in its Circular 18698 make that very clear, that delegation happens when the Luxembourg Manco ensures that all the mandate in another EU country or third country follows EU rules, and appropriate due diligence and contractual and supervisory oversight happens. And that really depends on the existence of the relevant MOUs. And as we've said, that's in place. So there's a lot of the technical concerns around delegation have really been put to bed by the signature of those MOUs. Now, there's some ongoing concerns about the level of substance, oversight, and that's part of a wider debate. I mean, and as we see, and this is not just linked to Brexit. As we know, the CSSF is very much in the process of discussing the position of transfrontalier in Luxembourg, and with people working at home and unable to commute due to COVID. So I think this is also part of a wider issue. And the reassurance we've had is that the basic business delegation model is not going to be interrupted. So that's really important in being able to provide European consumers the choice of mandates, the choice of investment opportunities, which suits their investment style and wherever they are in the world, to give them the best in class options. So that that has actually been, a lot of work has been done on that in order to clarify some of the more technical, substantial concerns. But that is something that we're actually pretty now in a position we're pretty reassured about. What are the couple of other areas? Michael also mentioned the MiFID marketing services. Clearly, one of the issues, we, as many other firms, relied on being able to rely on MiFID services to passport services such as distribution, discretionary portfolio management on an individual basis around Europe. Those we have restructured in order to be able to provide those services from European entities. So the European client will talk to an individual who's appropriately authorized within one of the member states of the EU. And we're very much aware of the restrictions of fly in, fly out. That's the sort of model. That's a model of the past. That's not the model of the future with the EU. But we've had quite a lot of warning on this. We've had 4 years to prepare, which is not, the key thing that we've been worried about is the cliff edge. And so we've had time to adapt, prepare, and organically grow our businesses in Europe so that we can support our European clients. So that's part of it's to build up that longer term partnership with clients in the new world. Finally, one thing I would say, which is very specific to asset management, is that the UK remains a major export market for Luxembourg funds and for Irish funds on the other side of the sea. And the way the UK onboarded EU legislation into UK law was that both Irish and Luxembourg UCITS automatically became AIFs, and as such, not eligible to retail marketing. Now, that was a slight sort of semantic nonsense, given they've been marketed to UK retail investors for decades. And the UK government very sensibly put in a temporary permissions marketing regime. And they will be announcing shortly in a financial services bill a new recognition regime, which will allow Luxembourg and Irish UCITS to continue to be marketed to UK retail investors. And that is something that happens without equivalence. This is something that the UK has said they've recognized the facts on the ground. There's a big market there. We don't want UK investors to be forced sellers. In many cases, there isn't an equivalent UK product that easily, if we take money market funds, if we take ETFs, that could easily be replaced. So that the exact details are still under discussion, the equivalence decision, but we have a very clear route map. So I think those are that really sums up how a lot of our concerns have been met in order to be able to service clients without a cliff edge.
Thank you very much, Martin. Yes, Luxembourg funds are sold all over the world. It would be strange if they could not be sold as UCITS to retail investors in the UK, but I understand your point. Pierre Mackel, your main worries for the insurance sector from a Luxembourg perspective?
From a Luxembourg perspective, I think, and I've already briefly touched about it, but the London insurance market is quite important also for the European insurance sector. For many years, clients went there in order to have their risk insured, whether it is for specific risk or for large risk. And whether at the end of the year it will remain the same, clients will still go there in order to obtain the kind of expertise that the London insurance market is able to provide. And that's the reason why for the insurance companies, the access to the London market is crucial. That's also the reason why a lot of European insurance companies, in anticipation of Brexit, have decided to establish a presence, a branch in London, in order to be able to continue to serve this client, but also to rely on the specific expertise of the London insurance market. And this expertise cannot be duplicated overnight just because of Brexit. It will take some time. And so this is a reality that the insurance company needs to face. And the ability to continue to rely on such model and to have a presence in London in order to serve the client is an important challenge for the insurance sector. The presence in London is not, like I've heard many times, a way to do backdoor passporting from London back into Europe after Brexit. This is really to cope with a reality that the insurance companies are facing. This is maybe one of the main challenges that I can see for the insurance sector. The other one that I just wanted to mention is, of course, related to the equivalence decision. It is important that we have a clear framework with the UK regulatory environment. This will have an impact on reinsurance arrangement. A lot of European insurance companies rely on reinsurance treaty concluded with reinsurer based in the UK. And whether or not such reinsurance arrangement will be recognized by the European authority is of the utmost importance for the sector. The same goes for insurance group and the ability to have a consolidated supervision, taking into account the supervision that will be carried out from London. It is really important in order to have a group supervision, a strong and sound supervision, to be able to rely on what will be done in the UK. And I will not come back to the point that was already made by Michael and Martin in relation to the cooperation between regulators, but it is indeed one very important point. We need to have regulators that are able to talk to each other, to exchange information, to organize on-site inspections, also to discuss common matters that apply the same whether we are on one side or on the other side of the channel. So for me, these are the main topics that are quite challenging for the European insurance industry now.
Thank you very much. I'm just looking at Chris. Do we have questions coming in? He is very happy, so that's excellent. You just talked about the attitude of regulators, and Michael talked about some sort of protectionism. When you look like what the regulators say for the moment, among others, ESMA talking about increased substance, talking about people on the ground in the different countries, asking questions about excessive, what they consider excessive delegation. The business model going forward, will it have to still be adapted further even after Brexit? Perhaps, Michael, can you tell us what you are seeing and what you are doing in your sector, and also specifically with JP Morgan regarding your business model for the future?
Yes, absolutely. And before talking about business model, I guess I'll come back to this point on protectionism, just to make sure I'm clear. And I don't think I would say the EU or currently characterize the EU as being a protectionist location, right? I think my point is more that the tools are being put in place in order to create barriers to cross-border trade. Though currently the EU is very open in lots of different ways, that is something we see value in preserving. And if it is to change, I think there needs to be a very clear understanding that there will be impacts of that change, and so on. So we can understand, for the future of Europe, where the winners and where the losers are. In just the same way that we would if we were, talking to ESMA or EBA or any other regulator globally about a new piece of regulation, and making sure that it's done in an appropriate, sophisticated way that maximizes the upsides and minimizes the downsides in terms of impact on the economy. So I think that's an important kind of thing to level set on as we go forward. And that then is mainly when we talk about those issues, we talk about market access and ability to do flows cross-border, and which I mentioned already. But obviously this question of business model and the operations of firms themselves, it's another very, very important leg of this similar question. Without a doubt, with Brexit, we will see impact on business model. And Martin's already kind of alluded that this question of substance is something that's not just driven by Brexit, and rightly so. Whereas previously we were able to operate pretty seamlessly for the goods and the bads of Europe, and capital markets union, banking union needs to with space to improve, but relatively seamlessly in a global context across borders. Now we have a separation cleaved right down the middle of that operating model, and we need to be able to adjust for that, right? So firms have been very diligently and strongly working away on these issues in the faces of the uncertainties that we have for the last number of years. Regulators have been very clear from the outset, as they should be, that they don't want empty shells as entities, and so that does mean directionally more substance in entities, making sure that the governance is fit for purpose in entities. But as with all these things, it's not binary, right? This is a spectrum of outcomes, and the question of how much is enough, and how much, how many compliance staff, how many audit staff, what structure you have within the entities. There's a lot of devil in the detail on all these questions. The one thing, obviously, that's very important to global firms is an ability to provide services within a group. And there are obviously efficiencies for doing things in a centralized way across a group, and a benefit to the firm itself, but also, and I think this needs to be recognized, an ability to drive better outcomes for the legal entity, for the local entity, through having access to centralized capabilities, expertise, and ultimately leading to a stronger risk and control environment for that entity. And I'll give as an example, because it's a very clear-cut one, cyber monitoring and resilience, right? It's hopefully obvious to everyone that that's a very highly specialized technical issue that firms cannot compromise on their ability to protect themselves on the cyber front, and doing that in global centers of excellence is without a doubt going to lead to better outcomes for the group itself, the JP Morgan Group in this case, but also for the JP Morgan entities in Europe. And of course, we need to back up intra-group provision of services like that with a clear benefit to the group, with sufficient local governance, sufficient oversight and decision making through the local entities, and that's obviously a very, very important factor for both the entity itself, but also for the regulators locally. So these questions, I think these are the types of questions we're going to be grappling with for the next number of years as we settle into a post-Brexit landscape and environment, and this will have impacts on firms across Luxembourg, across Europe, in fact on for global firms across the globe. It is something that Luxembourg has historically been oriented towards, is providing a good environment for global firms looking to operate as part of their global business model from Luxembourg. So this is obviously for people on the call, I think this should be a key issue going forward.
Thank you very much. Yes, the question is, if you have to do more on the ground, you can delegate less. The question is, where in Europe do you go? Pierre Mackel, do you see a clear trend? I think, especially in the insurance sector, we have been quite successful over the last couple of years, no?
Remains to be seen what is to be successful. Of course, the European insurance sector has a lot of opportunities ahead of it, and Brexit is an important impact. I've already mentioned the importance of the London insurance market. I do believe that over time, this London insurance market will lose a little bit of its superb, and this will be accompanied by a reinforcement of other European insurance centers back in continental Europe, and Luxembourg is clearly one of them. With this movement, with this, I would say, rebalancing of the insurance center in Europe, we will be also see more expertise developing in other jurisdictions than in London. And with that, a more, I would say, robust move from people around the world to be attracted in Luxembourg or in the continental Europe. In terms of business model, I do think that Brexit shall also have another impact. A lot of the insurance company had to work very quickly after the aftermath of the decision to leave the EU. And they had to relocate the European business back into continental Europe, and also to segregate the portfolio, segregate from the UK business from the European business. And now we have newly established insurance company in Europe with a new insurance portfolio. And when looking at this with this new angle, this will create new opportunity, but also additional challenge for this newly established company. And so I do believe that we may expect in the upcoming years a revisit of the current business plan of this insurance company in order to see whether on specific market there are additional opportunity, or whether there is also opportunity to exit certain markets when only looking at the continental European portfolio. And so maybe there will be additional consolidation in the upcoming years. Of course, Brexit is one phenomenon, but we should not forget that there are other very important developments around the world. The COVID is, of course, one of the important ones, and also the digitalization. And the way we are doing business today will not be the same way that we will be doing business tomorrow, after COVID, after an increase of digitalization. And so the business model of the insurance company will change over the next years. I just wanted to mention maybe one point, and I really want to mention, because of course I'm a lawyer and it's important for me, but there will be also an impact on contractual arrangement, and sometimes it's not really correctly apprehended. For the moment, a lot of stakeholders, a lot of parties decide to subject their contractual arrangement to UK law and to UK jurisdiction. It has been the standard for many years. Of course, with Brexit, this will change. It will be more and more difficult to have a decision rendered by a UK court to be recognized in Europe. It will be also more burdensome to have to explain to a UK court what European law means. And I do believe that over time, we will see more and more parties that will opt for another law applicable to their contractual arrangement, and who will also subject their relationship to another jurisdiction, more on the continental ground. And this will also have an impact on the way we draft the contractual arrangement. It will not be only UK law focused.
We had managed up to now to avoid the word COVID, but I totally agree with you. COVID, when we talk about future business models, that is certainly also an element that we will need to take into account, the way we can work from home, perhaps more in the future. Future business models, Martin, also for you, I mean, you had a big fund range in Luxembourg already before Brexit that is being sold all over the world. What has changed since Brexit? What is the element of substance or delegation that you have had to reconsider, and what are you continuing to reconsider for the future?
So, Charles, one of the things that that drives our Luxembourg business clearly is clients and who's buying our funds and where they're located, and how we can support them adequately. So I think it's really worthwhile mentioning that Luxembourg remains the world leading platform. You know, Alfie research shows that Luxembourg funds are distributed in over 50 non-EU jurisdictions, as well as across the EU. And we've talked about the UK, but they remain a market-leading product for distribution in many non-EU countries in Asia. Take Singapore, Hong Kong, take Switzerland, and a significant presence in Latin America. So we see ongoing growth in those jurisdictions, and therefore ongoing growth in the Luxembourg funds and product development to support clients in those markets. And so that inevitably mean more resources to support the growth in the range. But I think it's also useful to think about what are the other sources of growth. I mean, I know today we've focused on Brexit, but if we look at 2030, and this is always looking at deeply into the looking glass. So I should probably be completely wrong, given that nobody predicted COVID for 2020. But what are we seeing now as some of the mega trends that will be driving growth? So clearly, there's funding recovery. And what we've seen in the EU is that there are hundreds of billions of euros sitting on the sidelines in cash, not invested, which need investing in the European economy, whether it's European SMEs, whether it's longer term projects, whether it's European growth companies. And so there will be a continued growth in alternative assets to fund this, as well as mainstream public assets to fund this recovery. That's going to be necessary, and Luxembourg will be playing a key role in this as one of the enablers. Secondly, climate transition and net zero targets. Individual countries are becoming ever more ambitious in their targets as the effects of climate change are hitting home. So the EU look at the Sustainable Finance Action Plan, what this means in terms of capability of skill sets that firms have to have in management companies, in their oversight and risk teams in order to be able to meet those challenges. This also goes very much for the UK. The UK has its own very ambitious targets, and you only have to look out at what is happening in the UK pension fund market to see the really ambitious plans that the UK government, the UK authorities have set out for UK pension funds in terms of meeting sustainable finance goals. And that takes me to what is a third trend, which will actually drive change in skill sets and capability. It's really clear that we need to focus on citizens' long-term resilience, and this is very much how can they fund their retirement? Demographics are showing people are living longer, and yet there is more and more pressure on the tradition in the post-war providers of those pensions, whether that is the state system and whether those are the corporate systems. We're not at all saying you have to get rid of those first two pillars, but you need to supplement those first two pillars with a stronger third pillar in order to ensure that people have adequate retirement incomes, and to make sure that that the burden of providing retirements for the future doesn't unfairly lie on future generations and the young generation. So that issue of managing money with intergenerational fairness will become increasingly important. So I think those set three key themes, which will be driving growth, skill sets, risk management, and where Luxembourg will have a key role to play. But importantly, also, all those issues are issues that also affect the UK. And so what we sincerely hope for is a real dialogue between the EU and the UK on these issues, because they are common issues that affect both our societies very closely.
Thank you very much, Martin, for taking us out of Brexit and out of COVID and actually highlighting the really important things for the next 10 years. I've noted financing the economy, I've noted sustainable finance, and I've noted pensions for the big challenges of the future. Chris, can we have a question if we have a question?
Yes, so firstly, thank you to all the panelists for a very interesting dialogue, and thank you to all of the people who've sent in questions. Maybe just following on directly from the speech there, one of the first questions is, does the panel have any views on the portability of pension funds between the UK and the EU and vice versa? Maybe Martin has some thoughts on that.
So I can say a little bit, because there will be regulatory concerns, and it depends on portability. It depends on what type of entitlement, when you're talking a state entitlement or corporate entitlement. So if it's a state pension, that comes down to very much to relevant treaties between member states, and that also becomes a tax issue. In terms of, let's say, corporate DC, there is portability comes down to the structures and the administration platform that you have, and that is something which is still fairly nascent in Europe. Pension schemes and pension plans are still very national. And so if you're going to have portability, you really need, as we've seen in discussions around the pan-European personal pension, is you need the infrastructure, the plumbing, to support the accounting, and to be able to say, if somebody has worked and been taxed in a jurisdiction for so many years and they want to draw down their pension in another jurisdiction, to put it, they've worked somewhere cold and snowy and they want to retire somewhere hot and sunny, that you deal with the issue of intergeneration, with tax fairness between jurisdictions, and that does require appropriate tax accounting. So not impossible, but a lot of hard work and a lot of discussion on that.
Okay, thank you very much. You want to say something, Mackel? No. Next question.
Yep. So a question here from Lamoulin. So big companies have already established either a subsidiary or a branch in the UK. But what impact do you think does the panel think there is on the less big players, the sort of medium or small size players? Is this a bigger problem for smaller players?
I can jump in on that one if you want. And yes, I suspect it probably is an issue. Bigger firms have more resourcing capability to be able to execute on changes and projects like this. So just in the transition, the relative burden for a smaller firm has to be bigger, you would think. Likewise, if we end up in a more decentralized model with more fragmentation between our various operations, the question of cost and ability to manage the cost in that entity and still return a sufficient return on equity from that entity will be challenged probably to a greater degree in smaller entities compared to larger entities. So, what does this mean at the margins over time? To my point about if you put up barriers, you get less competitive markets. Firms that have the scale to operate in those markets are fine. If you see firms exiting those markets because of those factors, that means less diversity of choice and innovation, etc., in the European economy. So that's one of those consequences, perhaps, that it may be in the smaller to mid-sized firms that we maybe see those consequences more apparently if they were to come to pass.
Thank you very much. And maybe just a corollary question then also coming in. As a result of Brexit, will EU or Luxembourg retail asset management fees charged to customers increase or decrease? I.e., is there an impact on, what's the impact on the end consumer, do you think? Maybe we could also expand this out to banking services or insurance as well.
Yes, let's start perhaps with asset management. Is there any impact, Martin, on your fees following Brexit?
So the question of fees and value for money is one that is really is a hot issue on both sides of the channel, and that is, the FCA did its survey of asset management market study a couple of years ago. The ESMA has been doing its ongoing study of fees and charges, looking at closet indexing. So I think I don't see a direct link as such. What I do see are other trends which affect costs and charges. We're in a long-term low interest rate environment, and that means that money has to work that much harder to deliver a return, and consumers are that much more sensitive to the costs of the services. And so, one of the questions we have to ask as an industry is there's so much money still in cash, is why consumers aren't seeing more value in the asset management services that are out there that they could benefit from. So that's, I think, that's a question looking forward, is further reflection on the value of the services we provide, the pricing that we do. We looking at the marginal frictional costs. Europe is still very fragmented. One of the things that we sincerely hope for with the Digital Financial Services Plan is that you can actually cut out costs in a lot of the whole distribution and advice mechanism. If we take about AML, Know Your Client, where every country has its own separate version, that adds a lot of costs, not just to us, but throughout the distribution chain. And so I think there should really be a real focus on really reducing those frictional costs so that we can focus on our core value proposition. That happens in the UK as well. I mean, the UK has its RDR, but there are still frictional costs sitting in the system. So it's not so much a Brexit issue, but it is a very pressing consumer issue that we need to look at.
Chris, one more?
Yep, sure. Coming back, this is a question from David Pike. So coming back to His Excellency's speech, there was a suggestion that UK regulation currently meets or exceeds EU regulation and implies that such regulation will continue after the transition period, whereas some other observers may have suggested that there is a different circumstances, particularly around financial services regulation. Where does the panel see financial services regulation moving going forwards? More divergence or less divergence?
Yes, well, I think both sides will be free to do whatever they want. I was going to answer a similar question, so I'll embed it in this one. For example, we have sustainability disclosures coming up. So that's a piece of regulation that will produce its first effects next year. By that time, normally the UK should be out. So we'll see a first example of a divergence between the EU moving on with one piece of regulation that might not be the same in the UK. How will that evolve, diverging regulation in the future? I think that's the question. Martin or Michael, who wants to go? Or Pierre Mackel?
Maybe I can just jump in. On this question, I think I agree that for the moment, if we are just looking at the UK regulatory environment, it is quite similar to what we have in Luxembourg. But I do believe, and this was to my understanding, and it's still a little bit blurry, but it is one of the reasons why some people in the UK decide to leave, is to be able to do their own legislation, to do their own regulation, and not to have to compromise or discuss with 27 other jurisdictions. So even though I do think that probably the global trend will be similar, I expect that there will be some divergence in the future in terms of UK regulation versus European regulation. And it would be really naive to think that the UK government will just follow any initiative that the European Union will take. They will take their own initiative. If they believe in some European initiative that will be taken, they may follow, but clearly there will be some divergence in the future. Let's not be completely blind on this.
Yes. Perhaps one of the views from our panelists in London on this?
Yeah, I'll follow on to that. And absolutely, I expect that there will be a difference in approach across both jurisdictions. And that's absolutely to be expected if you decouple the process, that you end up with a more decentralized outcome, right? That just goes without saying. I think we've already seen as well in the UK's announced policy approaches already, where they've said they won't implement the settlement discipline regime part of CSDR, which includes mandatory buy-in, which is due to come into force in the, well, it's a bit of a moving target, but in the EU in the next couple of years. And, you know, that is something that, you know, there was a lot of unease in the industry about those provisions, and a lot of discussion about whether the EU should change its course. You know, the UK has indeed announced that it's going to change course on that. And so already we have a live example of a different approach. And I think it's right that the UK should take its own approaches, as it is right for the EU to take its own approaches. But I would hope that both sides do strongly consider the benefits of alignment, right? That there's great efficiencies in terms of regulators being able to understand rules and have rules that are comparable across jurisdictions, you know, less chance of risk arbitrage, etc. So there's a lot of benefits of alignment, and we would hope that there is a close ongoing relationship, to our comments at the very start of this panel, that enables that close alignment on both the rulemaking side and the supervision side, in order that we kind of align as much as we can, but diverge where it's appropriate, and hopefully get like a better outcome on both sides of the jurisdictions as an outcome.
Thank you very much. Martin, any thought on this? Or?
Yes, I'd say one of the things is when we talk about divergence or alignment, in principle, we very much support alignment, but there's always been a level of divergence at national level, even within the EU. If you take fund structures, all the EU member states have, outside the UCITS brand, all sorts of domestic fund structures. The UK wants to create additional ones. That'll be no different from France creating its FCPRs, or Germany, its different types of Spezialfonds. So, you know, let's also put this in context that there is, we are not always talking about cross-border competition. That quite often we're talking about meeting the needs of specific local markets. You know, another area is really sort of consumer disclosure. We've had a very messy European process on PRIPS. The UK has said this summer they're going to take the time to consider what to do next, and that seems fair. When we were talking about digitalization earlier on, I mean, PRIPS is not a document that you can really look at on your iPhone, and the iPhone came in 13 years ago. So it's already fairly old technology. So, you know, it's certainly, you know, there's an opportunity for review, and this is, well, this is an opportunity as what would be the most useful way for UK consumers to consume this information. It is probably going to be the same core information on performance, risks, and costs, but it's just the presentational measures may be different, and that will reflect differences in local distribution. So really, when we look at is alignment, divergence a good thing or a bad thing, it is what has to be also sort of quite conscious of, does it create a competitive disadvantage? Is it creating a barrier? Or is this actually legislation really trying to meet specific needs? The UK sets up a new long-term asset fund structure in order to channel UK pension fund money into deprived areas of the north of England. Is that really a problem for the EU? So you know, we will see more of those initiatives. I don't necessarily think they're all that problematic or are representative of a race to the bottom. It is very much the UK thinking through how it can meet the needs of its own citizens, in the same way that the EU, with its MiFID quick fix recovery plan, is looking at the research. The EU is already changing to look at the needs of EU SMEs, which have a very different market structure than the AIM structure with nominated brokers in the UK. So I think it works both ways.
Yeah, Martin, I can hear nothing as permanent and change on both sides of the channel. That's a next debate that we are going to have at a future occasion. For the moment, I would like to thank my panelists. Thank you very much, to London and also here in the studio. And next, we started with a political speech. Perhaps we are coming back to a bit more of a political speech with the former Minister of Finance. Last session in a second.
Well, thank you very much, Charles, Michael, Martin, and Pierre Michael, for this very enlightening discussion, which certainly helped us to clarify quite a number of points. Before we conclude, let us take a step back and look at what the future relationship could or should be. To do that, I am delighted to welcome Luc Frieden, as Charles has already announced, Luxembourg's former Minister of Finance, actually quite an extended tenure at the time, 15 years, so that gives you quite a good understanding not only of financial services but of Europe as well. You have been going back and forth to the ECOFIN Council many times, and for many hours over this time. Who better than you to give us an educated view on what this relationship should be? Mr. Frieden, since he has left active politics, has taken on various different other tasks, among them, of course, as partner of one of Luxembourg's leading law firms, Elvinger and Prussen, but also as the chairman of the board of one of Luxembourg's largest retail banks, BIL, and as chairman of the Luxembourg Chamber of Commerce. Luc, what can you tell us about this future relationship?
Well, thank you, Nicolas, and hello to everybody. I think indeed we should look also a little bit at the longer term perspective, not only what is happening this week or what might happen this week, but I think the United Kingdom is and remains a great country, which, by the way, produced some great European statesmen. And by thinking about this panel, about this seminar today, I went back to read some of the speeches of Winston Churchill. And his great speeches, I found one where he spoke about United Europe, and it was in 1947 at the Royal Albert Hall in London. And he said that if the people of Europe resolve to come together and work together for mutual advantage, then they still have it in their power to allow the stream of freedom, of happiness, and of abundance to begin again the healing flow. That was, of course, in the context, 1947, of the war, but I think what he said then, and by the way, it's one of his only speeches where he expressed the view that Britain should be a participant rather than a well-wisher to a united Europe. I think what he said then is true also for the challenges that we face today. If you look at the challenges such as global security threats, terrorism, fundamentalism, energy and climate change challenges, global migration issues, international financial stability, and we were just talking about that, the geopolitical competition between China and the US on who will have the economic and technological leadership in the years to come, then I think this requires a strong European answer. And I think the aspiration to be sovereign, as Brexit reflects, is to some extent an illusion, because none of the challenges I just mentioned, and my list is not exhaustive, can be answered by one country on its own. You need to cooperate. Now it is true also, and you mentioned, Nicolas, how many years I was sitting at the European Council of Ministers. The United Kingdom was never, in my view, a full and wholehearted member of the European Union. They didn't participate in the euro, they had an opt-out from Schengen. In Justice and Home Affairs, they had an opt-in, so when I was sitting in the Council of Ministers of Justice and Home Affairs, each time we were wondering, would they participate, would they not participate? So I think the United Kingdom had a different view on what was going on in Europe, and that is, of course, reflected also in this 2016 referendum, next to being, on this European issue, a highly divided country. But I think there is no reason to cry over spoiled milk. It's always good to analyze what has happened, but we should now obviously look to the future. I would even suggest that we do not focus on Brexit anymore, but we focus on the United Kingdom, because Brexit took place. The United Kingdom left the European Union in January of this year. Why should we cooperate? The EU is and remains the UK's largest trading partner. 40% of all the UK exports go to the European Union, out of which almost half are financial services, and half of the imports that enter the United Kingdom also come from the European Union. I think the United Kingdom has much more to lose now than the European Union, because the United Kingdom will suffer a big shock when this Brexit will be fully reflected, combined, by the way, with COVID, which impacts us all. But I think there is, this will be a moment of truth in the economic history and the political history of the United Kingdom. Nevertheless, as I said, there is a need for cooperation in all the areas that I mentioned. And we will not have any more a common set of rules. I was not in the panel, but I carefully listened to what has been said. I think there will be divergence on many issues, and there will also no UK influence anymore on the shaping of future EU legislation, including on EU legislation in financial services. I can tell you from experience that the UK had a huge influence in shaping, in negotiating, enriching European legislation in financial services. All that will be part of history, and the European Union will go its own way. I do notice, I must say as a European with satisfaction, that since the United Kingdom left, or decided to leave in 2016, since it left this year, no other country in the European Union has asked or even considered of leaving. There is no majority in no European country anymore that envisages to leave the European Union. No Frexit, no Nexit, all this has disappeared. I think we have to think in the European Union, of course, what is the real added value of Europe? Which are the areas in which we should have, at the federal level, at the European level, common decisions, which of course require sometimes compromises, and what should we do at the national level? And I think the single market, common rules on cross-border financial activities, to talk about those that are part of the debate today, are of course issues where there is a real added value for the European Union to make progress. I think it's regrettable that we will have separate rules for the United Kingdom, again, and other separate rules for other neighbors of the European Union. This will lead to legal and other uncertainty. I therefore would welcome if the European Union would create certain circles of countries that within and without the European Union move together on certain issues. A kind of Olympic circles, and it's interesting that in the speech that Churchill gave in 1947, he also spoke already about the circuits. He said that some countries will feel able to come into our circle sooner. He was speaking about our circle, and others later according to the circumstances in which they are placed. I think by giving special rules to the United Kingdom, by giving other rules to Norway or Switzerland, we will make it too complex for companies, for businesses, for people to operate in this European continent around the European Union in the future. But we also should realize that the United Kingdom, like Switzerland, will now be third countries for us. They cannot expect us to give them the same rights. That is true for Luxembourg, that is true for the European Union. And yet, I think that if you live in the same continent, if you share common values, because that has not changed due to Brexit, you need to cooperate, and we should build this bridge through the United Kingdom. I say that in particular from a Luxembourg perspective, and also in particular from the financial services perspective. If I look at the bigger picture in financial services, I think there are at least three reasons why we in Luxembourg have a strong need to have a close relationship with the United Kingdom. One is there is a long-standing financial and business ties between Luxembourg and the United Kingdom. Look at the number of daily flights, look at the number of companies in Luxembourg and in London who work on a daily basis together. Second, I think there is a strong complementarity between the financial industry in London and in Luxembourg. And third, and I witnessed that in my many years in the ECOFIN Council, there was an identity of views on many aspects of international financial regulation. And I can tell you from experience that that identity of views did not exist with many other countries of the European Union. Therefore, I think Luxembourg has a strong interest in building a future relationship that is productive with the United Kingdom. Ideally, having a legal framework for continued connectivity for financial services. If not, at least try to be as pragmatic as possible. How can we do that? I think we can improve maybe aspects of our double tax treaty. We can ask for a strong cooperation between our supervisory authorities in the financial services sector, insurance, banks, asset managers, and so on and so forth. So I think pragmatic cooperation is key. We should also, despite the fact that the United Kingdom left the European Union, we should try to explore the opportunities for our companies to enter the British market. That's also why in the Chamber of Commerce we have decided to increase our physical presence in the United Kingdom by appointing an attaché to the Luxembourg embassy in London. I will personally, together with the diplomatic staff, monitor this situation, because I think the cross-border trade, the cross-border financial services between London and Luxembourg must remain strong in our common interest. Yes, the rules will be different. It will not be as easy as it was. The UK will not have the same access to the single market of the European Union, and I'm very doubtful whether equivalence in areas where equivalence is foreseen in the European legislation will be granted and can be granted, because I think that the United Kingdom will ask for different rules in financial services, maybe not now, but in the years to come. That should not prevent us from cooperating. And that's why I'm arguing strongly for a new and strong partnership between Luxembourg and the UK, and hopefully also between the EU and the UK in the years to come. Thank you.
Thank you very much, Luc, for these very inspiring words and the vision that you laid out to us. Well, let's hope that the negotiators will heed your recommendations for pragmatism. Ladies and gentlemen, we have come to the end of this program, and it remains for me to thank all our speakers, Luc Frieden, Ambassador Marschall, and then our panelists, Michael, Martin, Pierre, Michael, and the moderator, Charles Muller, for today's discussions, as well as you yourselves for taking the time to watch this program. I hope you enjoyed it and found it as useful as I did. In our next episode, we will focus on Canada on November 10th, followed then on December 10th by a focus on 2021, which I suppose everyone among you will hope will be as boring as can be. Before that, on October 27th, 28th and 29th, I invite you to join us for our Sustainable Finance Forum, which you will obviously be able to register on our website. And until then, ladies and gentlemen, stay safe.